Good morning, everyone. I'd like to thank you for joining this panel on development finance and debt sustainability. This is obviously part of the Global Development Forum, so I hope some of you were able to participate in the sessions earlier this morning. This panel, which got a shout out during a couple of the morning discussions, I think the issues around development finance and debt sustainability are ones that have been around for a while, but they're certainly getting some increased attention these days. So it was one that I think the organizers of the event put on the agenda, wisely so. I'm glad that all of you are here this morning with us to participate in the conversation, and also to the folks that are streaming this online. Let me do some just brief introductions of our panelists. I think you should have the full bios for them, but we're really grateful for their participation today. We're going to have just a few minutes of their introductory comments, and then we're going to open it up to questions, and really would like to hear what you all have to say and questions that you might have for them. Kicking us off is going to be Mark Flanagan to my far right, your left. Mark is the Assistant Director of the IMF's Strategy, Policy, and Review Department, and the Division Chief for SPR's Debt Policy Division. For those that know the IMF, you'll know that his department is the one where the policies are made, so among equals, a very important department there. Hopefully we will have Mr. Arias, who can give us kind of a country-specific perspective, join us. But then we'll hear from Sonia Gibbs on my left. Sonia is probably known to many of you that follow debt and debt policy issues. She's Managing Director of Global Policy Initiatives at the Institute for International Finance, the IIF, and they've done a lot of great work in this area as well. And then finally, on my far left, your right, we have Dr. Naoki Yoshino, who is here from the Asian Development Bank Institute, where he is the dean. He's also professor emeritus at Keio University in Tokyo, and he's going to bring us a really specific proposal that will introduce an idea for mobilizing private sector investment for development finance. So with that introduction of our panelists, let me just frame the conversation a little bit. As I mentioned before, this issue of debt sustainability is not new, but the intention that is focused on it has certainly been heightened over the last year and a half. And I would say that that's a function of a couple of different factors. In particular, I think there is a growing appreciation for the magnitude of investment needs. There's been focus in the G20 and other venues on infrastructure needs, but I think the appreciation that these infrastructure needs are coming not just from the developed world, developing world, but from the developed world. And when we think of infrastructure investment, it's not just traditional infrastructure, it's also digital infrastructure. CSIS has a report coming out in a couple of weeks, and an event on April 23rd on this issue of mobilizing infrastructure finance. And the numbers are really quite staggering. From that report, by 2040, they estimate an additional 94 trillion of global infrastructure investment will be needed. So if you think of those numbers, almost 100 trillion, how do you match that then with the pools of capital that can actually finance that? And how do you tap those pools in a way that actually does not imperil debt sustainability for countries? So these are really big questions. It's a good thing that the policy world is focused on these questions, and it's a great thing that we've got experts like this that can help educate us on these issues. So with that introduction, let me ask if Mark can kick us off here with just kind of an explanation of what do we mean when we talk about debt sustainability, and how does the IMF think about this?
Sure. Thank you, Stephanie. Let me just say it's a pleasure to be here and to be talking to all of you about these. Also look at as well when we analyze debt sustainability. Now, I'm going to actually start by reading you our definition. And it's a long and convoluted and complex definition, but it's loaded with stuff. And then I'm going to try to develop it a little bit for you. So we say that public debt can be regarded as sustainable when the primary fiscal balance needed to at least stabilize debt under both a baseline and realistic shock scenarios is economically and politically feasible, such that the level of debt is consistent with an acceptably low rollover risk on debt service and with preserving potential growth at a satisfactory level. So there's a lot of qualifications in there, as I warned you. So how do we operationalize a statement like that in practice, and what does it actually mean? So what it means is essentially two things. You know, when we look at debt sustainability, it really comes down to, can a country repay its debt over time? That is a probabilistic concept. There's no deterministic statement we can make about this because the future holds a lot of uncertainty naturally, and there can be wide confidence intervals over how an individual economy will evolve. So we need to operationalize this somehow. How do we do it? All right, well, we do it by first looking at debt dynamics. So what do I mean by debt dynamics? That's the expected evolution of debt over time. So how do we understand if that evolution of debt is a problem? Generally, debt sustainability analysis draws on some concept of a threshold beyond which there's a danger. So if your debt or debt service indicators get beyond such a threshold, we start to worry. How do we determine such thresholds? Well, there's a couple of ways you can do it. There's several ways you can do it. I'll mention the two we use. There's other ways in the literature. I'll mention one as well. But you can look at debt carrying capacity of a country. How would we think about debt carrying capacity? That's a matter of things like institutional strength, a country's income, its assets, its foreign reserves. These are various factors that have an impact on how much debt and debt service a country can tolerate. So we would generally take a look at these factors and determine debt carrying capacity. On that basis, set some thresholds beyond which we think if debt or debt service goes, there are dangers. Another way we can do it is we can do it purely by statistical methods. You know, we can pick out a few indicators and ask with simple techniques, like for those of you who know statistics, noise to signal. Pick the level of debt that generates the best signal of debt vulnerabilities. So we can do it purely statistically. And there are other methodologies mentioned in the literature as well. Things like studying, the fiscal reaction function and how much adjustment can a country do. And are we at a level, and what's the level of debt beyond which no fiscal adjustment is going to stabilize the situation. So we start off with these thresholds and we compare, and we get some signal from that. But that's what we call a baseline signal. That's our expected forecast. But as I said, economies evolve in different ways. There are shocks, commodity price shocks, natural disasters, international financial shocks. Lots of things can happen that can move a country away from its baseline. So we need to look at stress scenarios as well. And we need to have some judgment about what stress scenarios are most likely. Now, it's standard practice to look at, shocks to individual variables, like what happens if GDP growth were to drop significantly. So what happens if there's a recession? But, in the latest modeling, there's a lot of focus on what we call tailored scenarios. So we might try to model things like a natural disaster. How would it affect the debt dynamics? Or a commodity price shock, a global commodity price shock, if we're dealing with a country that has a very high commodity exposure. How would that affect its debt dynamics? And even things like a market financing shock. So the market loses confidence in a country and you get a big run on the currency. How would that affect debt dynamics? So we look at these stress scenarios as well to also get a sense of how debt is going to evolve. And try to make a judgment on where we think debt is going to end up in the medium term, whether debt is going to stabilize and come down to safe levels, or whether it will continuously rise over time. What is that medium term? Now, there's a trade-off here, right? The farther you go out predicting into the future, the less accurate you're going to be. So the more you're going to have to think about stress tests and trying to understand the probability around certain outcomes. But typically, the modeling goes 5 to 10 years when people do this. And when we're looking at how things evolve relative to thresholds, we look at things like the timing of breaches of these thresholds, their duration, their size, and we try to draw some judgment on that basis. Now, one thing I want to point out is we also have to think about contingent liabilities, and this is going to pull us back to what do we mean by debt? What do we mean by debt? So to do a debt sustainability analysis, you have to define, what is the debt? What is the government concept you're using? Now, a contingent liability is something that is not right now a legal obligation of the government, but could become a legal obligation of the government under some trigger. If you think about our coverage, imagine that we do our debt sustainability analysis looking at the central government. Well, any other liability that isn't the central government's could find its way back onto the central government's balance sheet. And historically, we actually see a lot of this. So what are these other liabilities? Things like general government liabilities, local and state government liabilities. An awful lot of governments are moving into the territory of public-private partnerships, and I've seen quite a few special purpose vehicles popping up now particularly in resource-producing countries in Africa. So these are contingent liabilities. State enterprises. There's been a huge shift of borrowing towards state enterprises in a lot of countries. And sometimes that's guaranteed explicitly by the government. Sometimes it's not guaranteed explicitly by the government, but we know the government's not going to let its water company fall into foreign creditors' hands. So we call that an implicit contingent liability. And finally, of course, there's financial sector contingent liabilities. And these can be very large. They can run in low-income countries to 5% of GDP. In higher-income countries, they can run to 20 to 25% of GDP. Just again, to give you a sense of size, we see countries out there with a stock of public-private partnerships as high as 50 to 60% of GDP, which is a huge number. The average is much lower, but you can see there's a long tail there with a lot of countries, with a few countries doing a lot of things. So we have to think about these contingent liabilities as well and how they could affect the dynamics. And again, we need to make a judgment. So if we compare to thresholds and we see that under a baseline scenario, debt is constantly rising and isn't coming down, it is above thresholds, we will likely call that situation unsustainable. Is there a policy scenario that could fix it? Well, that's the next question we need to ask. So what is realistic in terms of a scenario that could maybe move the economy off its baseline? What is realistic in terms of a fiscal adjustment? Remember, I emphasized that when I read the definition at the start. What is politically and economically feasible for a country to do? This is an important area right now of research, particularly with so many of the countries experiencing debt distress being low income and facing an imperative to try to meet the SDGs by 2030. So how do we account for that? Countries have human development needs. Countries have social safety net needs. How do we account for that when we think about a socially and economically feasible scenario? We do. We have to worry about that. So we need to look at realism of projections, realism of alternative scenarios, and make some judgment about that. And then finally, the last thing I want to mention, these are high-level issues. Obviously, we could go into technical details to the extent you want during the question and answer. But the other thing we need to look at is whatever framework you write down, there are going to be things you can't capture in it. Every framework is imperfect. And if you have tried to capture every last element in your framework, I guarantee you that is a terrible framework. Frameworks like maps need to be small so that you can use them, right? They can't be one-to-one on their scale. So, there are other factors you need to bring in. So whenever you do these kind of analysis, you need to think about things like, how does the government's asset position affect our analysis? Because typically we do debt sustainability analysis on a gross debt basis. How do we think about things like The availability of contingent instruments. Suppose countries have hurricane clauses in their bonds. Some Caribbean countries have these. How do we think about these sort of instruments and how they affect our analysis? And a whole host of other factors like debt structure. Who are the holders of the debt? Are they likely to roll over? So a whole host of other judgmental factors have to be brought in at the end. So in sum, debt dynamics under the baseline. It's a complicated issue. We need to know debt carrying capacity in some sense. Stress scenarios, we need to think through these. We need to look carefully at contingent liabilities. We need to go back and take a look at the realism of alternative scenarios, and we need to bring in other judgmental factors to come to a full view about the sustainability of debt. Last thing I want to say is anybody who's ever done this knows that, if you get it right, if you get a forecast of sustainability covering 10 years right 6, 7 times out of 10, you're doing really, really well because of the natural uncertainty of 10-year forecasts. So there's an element of art to this as well, and experience certainly helps. In any event, that's a brief and high-level overview of how one thinks about debt sustainability issues. And again, I'd be happy to answer your questions later. Thank you.
Thanks a lot, Mark. And having kind of witnessed when the fund goes through the process of even just revising an existing framework, it's usually, like 12 to 18 months. So summarizing it in 10 minutes is really an impressive feat. Exactly. We're very glad that Cesar Arias is able to join us today. You will have seen from his bio, Cesar has a wealth of experience, both public and private sector, that is relevant to today's discussion. He's currently Director of Public Credit at Colombia's Finance Ministry, Hacienda. I think you've got a presentation for us that can actually bring us from that 40,000-foot level that Mark just walked us through to kind of an on-the-ground perspective, and what does this mean at the country level when you're trying to finance these projects. I'm told that it's just 2 arrows back and forth.
Well, thank you very much to CSIS for this kind invitation. It's a fantastic subject, and it's a pleasure to be in front of a distinguished audience and distinguished panelists. The big question that I will try to address is how to finance infrastructure in an emerging market economy that has a large deficit in infrastructure investment, but at the same time, keeping your debt sustainability in check. So I have a few slides for you, just on the basics. We launched 4 years ago an infrastructure program that we call it 4th generation. And it's called 4th generation because we have done 3 generations before. And this 4th generation program adds on all the lessons learned. It's basically toll roads. So we were into a very careful process selection for the projects. And what you see there is the 20 toll roads. In Colombia, this will be the interstates, I-95 and things like that. The essential roads that you need to get to the ports and to get to the main cities. On the right-hand side, or left-hand side for you, you will see the financing sources. The way we did this is not through debt. So when we had the dilemma into choosing, are we going to issue debt? We decided to do future budget allocations. So we didn't want this to be reflected in the debt burden, but we self-impose a straitjacket in terms of expenditures over 20 years of the projects. And you see there that we have been making progress in diversifying our sources. Initially, half of the program was funded by the domestic banks, but over the last 2 years, we have increased into some instruments of financial innovation that I'm going to describe to you. So we have to be innovative, and we put 4 alternatives. First is the ability for foreign investors to set up infrastructure funds. At the beginning, we got 3 debt infrastructure funds, but lately we were successful in bringing the first equity infrastructure funds. So this is seed money that a foreign investor brings in that helps to crowd in also money from the local pension funds that were at the beginning absent and then participating. And you will see there how we've been able to spread the risk. So the first one is from a multilateral, CAF, the Andean Development Bank, another from a local broker, Credit Corp, another by BlackRock, another by Ashmore, and finally from the Pension Fund of Canada, CDPQ is being our first equity infrastructure fund. The second innovation that we had is what is called in other countries the mini-perm, is to be able to finance through the most difficult phase, which is the construction part, because you have a lot of construction risk, at a very short term, and then be able to, once that construction risk has mitigated, then you refinance through the markets or through a bond. And so we introduced the mini-perm, and now we're going to have our first project being financed through this instrument. We have also issued bonds, not the sovereign, but as the project finance, as a standalone, without a government guarantee. Unfortunately, the bonds at the beginning were issued only in dollars or inflation linkers. The next step for us is to be able to issue these bonds in Colombian pesos, because a big concern from foreign investors particularly is FX risk. And the fourth innovation that we put out is our national development plan with its own balance sheet that was capitalized through a privatization of a company, is now lending in local currency to multilaterals with the condition that multilaterals can on-lend to infrastructure projects. And you see there that we have had 3 successful operations, one with the Andean Development Bank, another with the Inter-American Development Bank, and another one with a Spanish Institute of Official Credit, which is like an ECA. This is crucial. When you think about infrastructure and sustainability for public finances, it's all about the allocation and the management of risks. I'm not going to go into a lot of details there, but what you see here, and I will ask you to then spread the presentation around, is that there are certain risks that have been traditionally being borne by the public sector. And in those risks, you have the ability to put tolls, force majeure, of course, and FX risk at the beginning. And at the other extreme, you have certain risks that we have been successfully putting into the private sector: traffic, taxes, financing, and insurable force majeure. And there are certain risks in the middle that, depending on the country, and in our case, we have been able to partially share with the private sector. And in those risks are environmental licenses, land rights, and construction and engineering design. So we started in the first generation in the 90s from an overall distribution of 80% risk in the public sector and 20% risk in the private sector. We moved to 70-30, and we have reached our optimal point in this 4th generation program in a risk distribution between 60 and 40%, with the nuances that you will see right there. Finally, I just put, this has been essential for us because, one, we find the financing, we allocate the risks, we created a system of provisioning for these contingent liabilities. So in my office, in the Ministry of Finance, all the PPPs have to go through a process of valuation. And once we value the contingent risks, we ask every project from the participation of the public sector to provision to what we call the contingency fund. This contingency fund has already disbursed payments for the materialization of risk, as you see there. The most problematic risk has been land, for example, and we have disbursed something in the order of $360 million. So those are the flows, the payments, but in terms of the stock, currently, that contingency funds is being pushed in infrastructure. Now it has grown to something like $828 million. And we have a very similar distribution of risk for the future. So I hope I met the 10-minute mark, and I'll be happy to answer any questions.
You exceeded the 10-minute. It was 8 minutes. No, it was perfect. You exceeded the performance metric and came in under 10 minutes. So we had, Mark successfully explained kind of the global environment for assessing debt sustainability in 10 minutes. You just went through Colombia's financing plan for the last 10 years and how you're financing infrastructure investment in 10 minutes. So that was excellent. So that's a high bar for you, Sonia. But we're going to turn to Sonia now. As I mentioned before, I think for folks that are following issues around debt sustainability, and debt transparency are probably familiar already with Sonia, but the IIF has done a lot of good work in this area. And I'm curious, you can probably speak to how this all looks from a private sector perspective and how the IIF is kind of bringing that perspective and advancing this work on transparency. So please take it away.
Thanks, Stephanie. And on behalf of the IIF and our 450 members around the world, mainly financial institutions of all stripes, banks, institutional investors, and so on, we've spent almost 40 years now thinking about sovereign debt issues, tracking capital flows, and thinking about the implications of the massive buildup in global debt over the past 10 years. And I would just say a couple of words here about the backdrop for global debt. At our last count, which goes through the end of 2018, total global debt across all sectors stands at $243 trillion, 317% of global GDP. Now, that's not just governments, that's also households and the corporate sector, the financial sector. But adding all that together, that's a massive number. Our focus here today is on government debt. And to put this into perspective, mature market government debt is now close to 110% of GDP, up from about 65, 70% prior to the financial crisis. And if you think of maybe 60% of GDP, Mark was speaking about benchmarks, 60% might be seen as a benchmark for a manageable government debt level, 110% is pretty high. And high government debt in mature markets is absolutely a problem. At the end of the day, it's likely to translate to weaker economic growth going forward. But for our discussion today, it's the more vulnerable emerging and developing markets that tend to be more at risk of the kind of debt sustainability problems that Mark was speaking about. And here I want to give just one example to put it into context. And we looked at a sample of sub-Saharan African countries that had previously benefited from debt relief. My colleague Jade, sitting over there, did this great work. And after debt relief, measuring from around 2010, debt to GDP levels for this sample were around 35%, quite manageable government debt. But after years of low global rates and easy borrowing conditions, debt to GDP for this sample of vulnerable countries in sub-Saharan Africa has risen to around 75%, meaning higher risks for debt sustainability, obviously. In addition, there's been a shift away in many of these countries from financing at concessional rates. In other words, instead of relying on lending from the World Bank or other multilaterals, many vulnerable countries have been borrowing in international bond markets, and in some cases from bilateral sovereign or quasi-sovereign lenders. And China's a clear example here with its Belt and Road Initiative. Importantly, a lot of this newer lending has been done at non-concessional rates, meaning debt service costs are higher. And this kind of shift in the creditor base will have consequences. Some of these are a little bit masked right now because global rates in general are still very low, but this won't always be the case. And the bottom line is that higher debt to GDP levels and greater reliance on commercial creditors means debt sustainability risks for some vulnerable low-income and developing countries. And especially, I think, when there's not always a lot of transparency about all of this lending. So if you borrow in bond markets, that's pretty transparent. You can see what's going on. It's clear to the IMF what's going on. In some cases, some of this debt has been done in a kind of a non-transparent way, and that's what we've been particularly worried about. So the private sector, the private sector is by no means homogeneous, right? I mean, there's this great range of actors. But I think in this context, one point of common interest is certainly debt sustainability. whatever type of lender you are, if you're a bank, an institutional investor, you're private equity, even service firms like ratings agencies, law firms, everyone is keenly aware of the importance of having credit extension be in line with the ability of borrowers to manage this debt. And in this context, I'd also mention there's a lot of emphasis on sustainable finance among our private sector members. Sustainable finance is a lot broader, of course, than debt sustainability, but it does encompass the idea that the private financial sector needs to support the Sustainable Development Goals. And when you look at those 17 SDGs, number 10 on reducing inequality, and number 16 about strong institutions and reducing illicit financial flows are particularly relevant here in the context of debt sustainability. So from a private sector perspective, debt sustainability is a big element of market pricing, right? When lenders think about how to price their credit extension, they're thinking about the ability of countries to manage the debt. So ways to look at debt sustainability, like the tools that Mark was outlining, the debt sustainability framework, also the medium-term debt strategy as recommended by the G20 guidelines, those are an essential part of the toolkit for any private sector lender. They have to be, right? I mean, they're not in the business of lending money only to lose it. So bottom line, the private sector has a very strong interest in supporting debt sustainability. However, I would note the private sector cannot and should not assume responsibility, direct responsibility for debt sustainability. It's ultimately the responsibility of the borrower, obviously with advice from the IMF and other advisors where appropriate. And moreover, as we've just been discussing, determining debt sustainability is a lot more of an art than a science, and there's not a single correct way to do it. And from a private sector point of view, there shouldn't be a single correct way to do it. It's not a kind of a, uniform cookie-cutter tool. Each lender goes about it from their own perspective. So the purpose of market pricing, determined by the collective interaction of credit decisions taken by this wide range of actors, is to make an assessment of how best to allocate capital, right? A market assessment. And for countries where debt is approaching unsustainable levels, this implies that the price of capital should become prohibitive. Of course, that's not always been the case the last 10 years or so because global rates have been so low. It's been suppressing borrowing costs more generally, but that's a whole other story. All that said, we firmly believe that the private sector can and should take responsibility for bringing more transparency into sovereign lending markets. Greater transparency can bring a whole range of benefits, including improving the flow of information, not least to the general public, and the man in the street, the woman in the street ought to know what their governments are up to. Reducing the risk of shocks, for example, in cases where hidden debt has sometimes resulted in an enormous and very abrupt increase in debt to GDP levels. And debt transparency should also promote good governance, better fiscal management, and make it easier to fight corruption. So shining a light on all of these areas. And more transparency could even ultimately result in lower borrowing costs for responsibly borrowing sovereigns. And I think the IMF's done some work on this topic over the past year or two. But the key takeaway here is that more transparency in sovereign debt markets should support debt sustainability. So toward that end, we at the IIF and our members have developed a draft set of voluntary principles for debt transparency. It's not easy, as you can imagine, but we've brought together a very dedicated working group to make it happen. And this debt transparency initiative has the strong support of our board and a strong steer from official sector bodies, including the Paris Club and the G20 International Financial Architecture Working Group. And we've been very grateful along the way to Mark and the IMF for their thoughtful advice on developing these principles, because it's not an easy task. So at the outset, we're going to start with the PRGT countries eligible for concessional financing. And the principles are focused again, in this first iteration. We can sort of expand the scope going forward, but we have to start with a definable task, focused on external hard currency lending, because that's where sort of the bulk of the problems have cropped up. And you can make arguments for being broader in scope, a bigger group of countries or including local currency lending. But, from our point of view, we have to be able to kind of start with something we can manage and have a well-defined group of borrowers in scope. And it's important to point out here that we, the IIF, operate on the basis of consensus. So we need to be able to get agreement from our members to proceed. So we start with this narrower scope, and we'll be reviewing these principles annually to determine where adjustments might need to be made. So the actual disclosures are pretty straightforward, what you might imagine, at least in concept. The borrower, how much is being lent, any kind of guarantees, some kind of indication of the cost of borrowing, like interest rates, maybe reporting in a range, what currency they're borrowing in, what the governing law is, and so on. And we're not trying to add to reporting burden. I mean, when you think about what banks and other financial firms have to do in terms of disclosure of what they're doing, it's a tremendous burden to be reporting every single thing. And there are areas where transparency is pretty good. In publicly traded bond markets, for example, transparency is quite clear. Or where cover may be provided by an export credit agency. And we're leaving aside transactions that central banks engage in for monetary policy purposes, trade finance, short-term working capital, that type of thing. So there's a particular type of lending that we're trying to get more clarity on. Private sector lending to vulnerable countries. We still got a lot of points to work through, including potential antitrust issues. So apparently it's the case that banks and other financial firms, even when they're getting together for a good cause, it can be seen as collusion. So we have to be very careful about antitrust implications of what we're doing. We need a repository, a home for this data, a place where the data can be collected, housed, and made available in an easy-to-use format. And I think that's absolutely critical. I think some civil societies last week put out a wonderful piece which sort of said, look, the general public deserves to understand more about what their governments are borrowing, and they need to be able to access this information in an easy-to-use format. And we also need to think about what unintended consequences of more transparency could be. For example, some are worried about an overall reduction in lending to emerging markets that need the financing. They also worry that lending could be driven to less regulated corners of the financial system. And that also kind of highlights what you might call level playing field issues. In other words, if global banks, for example, are constrained in what they need to do and need to make these disclosures, but if other types of lenders are not facing these constraints, then the risky lending could simply migrate to another part of the financial system. So looking ahead, we're going to continue to work to build consensus within our membership, socialize the principles with the borrowing countries, because of course it's really important to have buy-in from the borrowers, right? We can't proceed with disclosure if the borrowers don't agree to waive sort of confidentiality provisions that are built into current contracts and such like. And our ultimate goal will be to submit the principles to the G20 for endorsement and then get them operationalized. So I'll stop here. I don't know if I made my mark.
Do you want to know? You were 1 minute over, but it's okay. It was interesting enough that we're gonna let that slide. No, that was, I mean, just to underscore something that you said, this link between transparency allowing for market pricing, and that market pricing really being essential to mobilize private capital, and kind of where we started the conversation, the magnitude of the need and the essential, the demand to really mobilize that private capital in order to meet that need. I think that's kind of the essence of what we're talking about here. So that was great. We're going to get now quite granular, and I say that in a very positive way, I think in a way to make this kind of more tangible and what we are talking about in ways to mobilize this private capital in a very specific proposal. So I'm going to pass it now to Yoshina-san.
Okay, thank you very much. Okay, thank you for inviting me today. I'm Naoyuki Yoshino. I'm from ADB Institute in Tokyo. I have 8 points to talk within 10 minutes. First one is about the budget. Many countries rely on general budget collected by tax. Germany, France, Japan had stock budget, which is collected from postal savings. And then it is deposited into Ministry of Finance, and they are allocated to infrastructure, housing, and SME. So if the country rely only on flow budget, tax budget, then infrastructure is impossible to complete because huge amount of money will be needed. Then there are two ways. One is we have to create stock budget. either postal savings, pension funds, or bring private sector finance into infrastructure. Secondly, rate of return from infrastructures were always very low in the past. That's why private investors could not invest into infrastructure. The reason is infrastructure relied on user charges for their income. Suppose water supply, then water price for the people, it has to be very low. But private investors, water price has to be very large. Otherwise, they cannot get enough revenue. So there are contradictions, users and investors. That's why PPP was not successful. Then we have to find out revenue sources not only comes from user charges, but also from somewhere. That comes from spillover tax revenues. Spillover tax revenues, for example, if infrastructure is constructed, water supply, then new apartments started to be created. Then property tax will go up, and new business restaurants comes in. Then property tax, corporate tax, income tax, sales tax, all goes up. But in the past, those tax revenue went to the government, and it was not returned to water supply company or investors. That is why they relied only on user charges, so the rate of return was very low. Then it is impossible to invest into water supply by private investors. But suppose these spillover tax revenues, 50%, were returned to water supply company and investors. The rate of return will continue to rise for many, many years. Then private investors are willing to invest into water supply and infrastructure. It applies to railway and road and many infrastructures. Spillover effects are very important. Then people are thinking about how to make spillover effects very large. Because local government, central government, if the spillovers are very large, they will be benefited. And both the investors and government. Then they are looking for the same direction. Then these spillover effects in many Asian countries can work for income equality. Infrastructure can bring new businesses. And then we started a hometown crowdfunding together with infrastructure investment. This finance will provide small amount of money collected by individuals in the region. Each people contribute about $10, $50. And 200, 300 people in the village will contribute money. And then many small businesses can start their own restaurant, shops along the railway and highway and infrastructure. And it turns out we started in Japan 20 years ago. Then it has been expanded to Peru, Cambodia, Vietnam, and Mongolia is interested in. And this hometown crowdfunding, ladies' business success ratio is much higher than men. Because men, if they have profits, they go drinking and they use all of the money. So it turns out this will also work for gender equality. And next, I'm talking about IT infrastructure also. And this kind of idea can be applied to information network. In India, IT infrastructure is now being handled by private sector. Their complaints are revenue only comes from user charges. So they cannot expand in entire India. But IT infrastructure has a huge spillover effects. So if my idea can be implemented into IT infrastructure, then all the networks all over India can be completed. And then I met a minister, a lady minister of IT communication. She was very interested in my idea. So now I'm collecting these spillover tax data in the region where IT was completed, and then compare the region where there were no IT infrastructure. Then I can show the big difference in their spillover tax revenues. Next, how to reduce risks in infrastructure investment. One of the biggest headaches in Asia is land acquisition. Landowners do not want to sell their land. My land came from ancestors and so on. Then it is very difficult to complete infrastructure. So I'm proposing land trust is one of the ways to smoothen, not to sell the land. Landowners can keep the land. and lease the land to infrastructure company. This method has been extensively used in commercial building and apartment building. So I'm going to expand the same method into infrastructure investment. Then Bangladesh, India, Indonesia, Philippines, all are very much interested in my idea, especially in Bangladesh. There are many, many landowners who are not in Bangladesh. They're working abroad. Then it is impossible to talk to them. Then infrastructure cannot be completed. But if my method can be applied, trust bank will be in between the landowners and infrastructure company. Then they keep those rent as a trust bank account until those owners come back from abroad. So Bangladesh, especially in the minister's office, is very much interested in. And last 2 points are how to reduce corruption in these infrastructure investment. In many Asian countries, there are lots of corruption. And then many people just put their money into the pocket. Then I think the best proposal is international organization such as World Bank, ADB, EBRD, will together with private sectors, so they can contribute 10%, 5%. Then they monitor where the construction company can be well selected and so on. So I think the role of international institution as a watcher for the corruption will be very important. Lastly, I would like to touch upon debt sustainability, which is slightly different from infrastructure. Japan has the highest indebted country in the world. Debt to GDP ratio is more than 200%. And it is much higher than Greece. And Greece went into bankrupt. Japan is still sustained. What are the differences between the two? Japanese case, debt are mainly held by domestic sectors, domestic investors, insurance company, pension funds, bank deposits. More than 90% of Japanese debt are held by domestic sectors because Japan had accumulated huge amount of savings. That is why our debt market is sustained. In case of Greece, 2/3 of their debt are held by overseas investors. Then they are not so stable. If the market is very fragile, then all of them go away. So I think that in the debt sustainability, we have to think about demand and supply. And it is often called a DOMA condition. It compares interest rate and growth rate of the economy. DOMA condition applies only to the US. The reason is US bond market, demand has nothing to do with, they don't have to worry about demand. US government bond is sold to the world. But Japan, Greece, other countries, debt can be only sold within the country. So I think that if we introduce demand to this equation, then DOMA condition does not any longer hold. We have to look at simultaneous equation of government spending, tax revenue together, and then in order to keep the sustainability of the budget. And demand for the bond market is very important. And debt market is also related to household debt, not only government, but also household debt that is growing in many Asian countries. Then we have to look at debt to income ratio or debt to sales ratio and interest rate and number of years of the maturity and also the growth rate of their sales, growth rate of the income. That will create that sustainability condition for the household debt. And I'm working for the Thailand and several other countries to apply my equations so that debt sustainability can be contained. So that's all my presentation. Thank you very much.
Interesting. Thank you. I would like to give you my compliments on spanning the range from a very specific project proposal all the way to kind of global macro issues and things that relate to global imbalances. So there was a lot there to react to. And I think, you're a fortunate audience in a sense that we have kind of this diversity of perspectives and views. So I feel like we've got somebody up here that can answer any possible question that you might have. I'm going to save the bulk of the time that remains for your questions, but I would like to just take the prerogative of moderator and kind of pose one question, I think specifically to you, Cesar, but I'd be curious to hear how the others think about it as well on the topic of contingent liabilities, which was a theme that kind of ran across all the different presentations. And how is it in the Colombian context that you're able to account for the contingent liabilities, but then specifically make those liabilities transparent? What's the process by which you're able to not overstate Colombia's debt burden, but give the market the sense for the potential liabilities that are out there? And then how would that look from the fund or the private sector perspective?
Thank you. It's a very difficult question, but it's a question that encompasses everybody: developed markets, emerging markets, low-income countries. The first step is to recognize the problem. You have two options: to hide liabilities or to make them explicit. And many countries are still hiding liabilities, either pensions, SOEs, infrastructure, judicial rulings. So I think you need governments, policymakers, and market scrutiny to demand putting things on the books. There's a second question, and it's about valuation. Valuation is critical in our experience because you can get the number wrong, as the IMF was pointing out, in the sense that it's very difficult. You operate with a lot of degrees of uncertainty. But if you value them, then you're able to provision for them, which is what we have done, at least in the case of infrastructure. At some point, you may say it's insufficient, the provision that you have, but you at least have a vehicle to mitigate that risk in the future. And finally, I think that there is a debate that hasn't been settled yet about, do you account it in the debt to GDP ratio or not? When I was a fund economist, the answer was not necessarily. The good practice at that point, but I will let you answer that, it was to have the debt to GDP, which is completely explicit, but keep an eye on your contingent liabilities. It's either the banking sector, SOEs, and try to have a plan to address that issue to avoid that it actually translates into your debt to GDP. But this is an urgent task. I was looking at the example of South Africa the other day in the press, and just a single company brought a problem of something like 5% of GDP in a single issue. So that would be my advice or what we have learned. So just make them explicit, value them, provision for them, and in that way you can at least address partially the problem.
Mark or Sonia or Shina-san, anything to add?
Sure. Well, first of all, I want to say I largely agree with Cesar. Just to illustrate a couple of things. First of all, contingent liabilities can be very wide-ranging. Some of the more difficult ones to put your finger on include the financial sector and public-private partnerships. We recommend countries publish fiscal risk statements as a comprehensive way of explaining to the public what risks they've taken and how much these risks could cost if they don't play out in the right way. In our frameworks, we have upgraded them to require enhanced disclosure of contingent liabilities. We still don't put them in the baseline, but we ask for enhanced disclosure and to work through literally sector by sector what's not in the baseline number and what is the contingent liability that could come from this, in a brief explanation of where that number, where that estimate that is being used is coming from. So that is our approach to this. And again, it's very consistent with what Cesar said, which is transparency and disclosure, essentially.
I would only add just briefly that it is a central issue that we've been thinking about in terms of what we ask our members to disclose, how it should be disclosed, because, you know, again, valuing these contingent liabilities is very difficult. I'd also say it's kind of interesting, this changing creditor base I mentioned. So some of these actors, especially your non-traditional creditors, say, for example, a private equity firm, are going to perceive the value of contingent liabilities differently, and they're going to price their credit differently. For example, maybe they figure they can just sit right down with someone in the government and have a better understanding than of what is being publicly reported. So there's all different kinds of consequences for the pricing of contingent liabilities, which of course doesn't make any of this any easier, but it really does highlight the importance of more transparency on what is reported and disclosed.
Thank you. And for the history there, I mean, I think I mentioned at the start that the profile of these issues has definitely been raised in the last year or so, but the nature of the issue has been around for a while. And I'm reminded of a policy paper that was put out by the IMF from the Fiscal Affairs Department in 2005. And the question was, what should be kind of the envelope for what's reported under government finance and how certain state-owned enterprises should be treated, whether they should be on government balance sheet and books or not. And the ultimate answer was a qualitative one, which is not always satisfying, but I think it's also kind of a theme here that it, you know, each one of these projects is going to, the factors behind it are going to depend. There's no kind of single approach, but the emphasis, again, as you've all made, on transparency and getting the data out there so that markets can actually make judgments, I think is pretty fundamental. So we have about 15 minutes left for questions. So I would like to invite folks in the audience. I think we have microphones that are, on either side here. If you could raise your hand, a microphone will be brought to you. If you could just identify yourself and your affiliation, we'll go from there. Gentleman in the bow tie here.
Hi, thank you all for your words today. My name is Matt Whiteman. I'm with a Montreal startup called Choco for Peace. We're doing peace building in Colombia using cacao and blockchain. And so I wanted to tie together a couple of things that I've heard today. Ambassador Froman this morning mentioned blockchain. Cesar, you mentioned the challenges around blending finance and mitigating investment risk. Sonia, you had talked about having a usable way to for people to get access to data on what governments are doing. Yoshino-san, you were talking about tracing, socioeconomic and environmental impacts and land trust, and it seems like the idea of blockchain is at the center of all this. So my question to all of you is, would you be able to comment on the current state of thinking and maybe deployment of disruptive technologies like blockchain in your various institutions? Thank you.
Observation really quickly. Perhaps you're offering to house our data with your
Pick.
Okay, I'll say a couple of words. The IMF is thinking carefully about fintech developments and how these affect global regulatory environment, how they should be accounted for by regulators. So we are considering it in the context of the financial sector. We haven't thought about it in the context of development. We are using, I would also say we are using AI and machine learning techniques in our internal research on debt sustainability work as well. So these things are coming in, but they take time to mature and come out into public.
If I may add, I'm not an expert on blockchain by any means. I'm a learner on that, but I would say two things. And one is related to fintech and formalization. In emerging markets, evasion or elusion rates are in the order of 30% plus. So if you have the use of technology helping to formalize and to broaden the tax base, I think that indirectly that will create a great benefit for the financing of infrastructure needs, social needs, and anything that you can put in the budget. On the other hand, this gets very technical very quickly. We are in the second generation of reviews of assessing valuation methodologies for infrastructure. At the beginning, it was a lot of Excel. Then we went through Monte Carlo simulations, and today we're just into artificial intelligence systems that will require several computers working at the same time to create our assessments and to stress test them. So although I deviated from your question a little bit in the sense that, I don't know, blockchain in particular, but at least in valuing and in formalization, they are definitely part of the answer.
Just going to add a little bit on a more serious note. Certainly, our members are investing huge amounts into these technologies. AI, blockchain in particular, is a relevance for financial contracts, right? So its use there is being well researched, and it's something that we're very interested in. So.
And I think your question prompted the theme for next year's Global Development Forum. So, all right, next question. There's a gentleman here with his hand up.
Yes, thank you very much for this panel. My name is Edward Hoyt. I'm an independent consultant focusing on energy and development. I guess my question is really something about understanding the kinds of forecasts that, or projections that you're incorporating into the stress tests, and specifically what the impacts of climate change are, and how those are being taken into consideration for stress test, not just in terms of the potential for natural disasters and a range of other impacts, but also the policies that will be adopted in future that will have significant implications for the fossil fuel industry.
So when you're thinking about climate change, you're talking about a many decade, even half century, full century phenomenon. It's very difficult to model the economics related to that, because we get into trouble about talking about what will the economy look like in 30, 40, 50 years. In some cases, it's quite simple. And we have these discussions where we see that there's a small island that under present forecasts about climate change will no longer be above sea level. So that's a prediction of lack of sustainability in economic terms, since the island will no longer be there. But in other cases, it's difficult. How would you project the impact of climate change in the United States, on the United States debt trajectory? There are a lot of things going on there. What we can do is we can look at natural disasters. And we've had high demand from our membership for tools to help them model the impact of natural disasters, particularly hurricanes and cyclones from respectively the Caribbean and the South Pacific. We can think about, at least from the fund's perspective, how we orient our policies to help countries affected by these disasters. And we have introduced new instruments to help us provide support, catastrophe resolution trust funds, for instance, that allow us to cancel debt in the event of a very severe natural disaster. Our rapid credit facilities, which allow us to provide immediate support. But these things are enormously difficult to model. And you get into projection horizons that for economists are very uncomfortable. I would invite you to think, for instance, back 50 years, which would put us in 1970, and think about the economic projections for the US, and think about how close we would have got to those economic projections 50 years ago. Or even better, think about what the economic projections were for China 50 years ago, and think of where we are now. So I hope you understand why it's very difficult to think about these issues. But natural disasters, which of course will become more frequent with climate change in a number of places around the world, we can concretize that kind of an issue within our forecasting horizons. Thanks.
Yeah, so I would just say briefly that what makes Mark uncomfortable makes global banks sort of terrified, because, you know, financial regulators are asking banks and other financial firms to disclose their ESG type risks. These are incredibly hard to model, right? And if you're going to stress test a bank or another firm based on these risks, we don't have the tools to do the scenario analysis. We don't have the data to put into the analysis. It's terrifying.
Hello? Okay. Taxing CO2 and NOx and bringing those tax to the green finance. Then the rate of return for green finance will be increased. Then portfolio allocation for green energy can be accelerated. Secondly, as far as natural disasters estimation, I'm using the same method to the disaster-affected region. how much tax revenue had been declined and how long, how many years. Then it turns out those tax decline becomes larger and larger. So that means the same kind of disaster will affecting much more severely in Asian region.
I tell you a little bit about the Colombia experience. We have no choice but to hedge against climate change. We're a tropical country right there in the equatorial line, and we are subject to earthquakes, hydrometeorologic, flooding, drought, depending on the time of the year and on the year. We decided to start spreading the risk and using market mechanisms to mitigate the impact of natural disasters in fiscal policy. Last year, in conjunction with the governments of Mexico, Chile, and Peru, we issued the first catastrophic bond that is triggered by earthquake events. So it was a total of $2 billion, in which the participation of Colombia is $400 million, and it's a 3-year bond. This year or next, we're working with the same partners to issue the first hydrometeorologic catastrophic bond. It is more complex. It wouldn't make sense to start by the hydro rather than the earthquake, but there's more data on the earthquake. And that's why it was easier to structure and actually to pull it off. So those are two instruments that we're using to share the risk with the capital markets. And the World Bank has been instrumental in this exercise, because actually the bonds are not in the balance sheet of the sovereigns, but in the balance sheet of the World Bank. So I think it's an interesting instrument. It's not the only one, but that's how we're starting to hedge against these issues.
I think we have time for one more very quick question. The gentleman here in the second row. Quick question, quick answer, and then we'll wrap up.
Thank you. Fascinating panel. Mike Ashford from Comonics International. Why aren't interest rates going up? 10 years of debt, people writing papers about modern monetary theory, but what's happening in the monetary markets that's we're expecting to happen and it isn't happening as a signal for the sustainability of the debt?
Well, one quick answer is that all this debt is also, and slower growth is acting to depress inflation amongst many other factors. And so I think without clear signs of inflation, global rates have a tendency to sort of stay low.
I'd just add that global real rates have also dropped quite significantly in the last 30 years. And that's pointing to real factors, right? Essentially a lot of savings relative to investment in the global economy. And you know, part of it is demographic in nature, part of it is related to where a lot of the growth has been in the global economy in the last 20 years. It's been in regions that save a lot relative to their income. These are reversible factors. I don't think we would predict that global real interest rates will remain low forever. It's a risk. It's a risk we constantly refer to in our country assessments. There are a lot of countries that are vulnerable to a normalization of global financial conditions, which means an increase in investment, greater demand for these savings, which would drive up real interest rates. But yes, it is a notable feature. And that bears on whether this represents a durable contribution to higher debt carrying capacity in countries. Obviously, if you think real interest rates are going to remain low for a very long time, you should have a higher debt carrying capacity if you're a country. The standard debt dynamics play off of the difference between the real interest rate and the real growth rate. the higher real growth is relative to the real interest rate, the better off your debt dynamics will be. And the higher you can afford to have the debt and yet still have it coming down, even though it's very high. So we'll see. But I mean, clearly there's and you probably know the authors who have actually called this a global savings glut. So.
Well, it's an excellent question to end what was an excellent panel, and I'd like to thank our excellent panelists for their contributions here today. So please join me in thanking them. For those that are watching us online, I believe the events will continue at 12:45, so tune back in then. For those of you that are here today, lunch is being served, I believe, up on the second floor and on the concourse level, so please help yourselves. Thank you.